here's the way it works. If we're going to let you exclude, if you're married, married filing a joint return, $500,000 of gain you can exclude from your tax return. In other words, if you buy a home for $500,000 and you sell it for anything less than $1 million, your gain is $500,000, and you can exclude the entire amount. No tax due at all. If you sell it for anything more than that, you buy it for $500,000, you sell it for $1.2 million. Whether you replace the home or not, it doesn't matter. That excess over the $500,000, that extra $200,000 is taxable. Unfortunately, if you sell a home nowadays, if you sell a home for less than you paid for it, unfortunately, the losses on sales of personal residence are not deductible. Is it fair? No, it's not really fair, but the IRS isn't about fair. They're more about economic trends and what's going on in the economy, and that's really how they make the laws. That's one of the reasons they made this a law a year or two ago that Desiree had mentioned about this exclusion for debt relief, which I'll get into in a minute. But so they changed the law. They said, okay, you're exempt for $500,000. If you're single or married separate, it's $250,000. You can exempt that from any capital gain. Now, there's only a slight variation to that. The rule is it has to be your primary residence. Those same rules do not apply for second residence, whether they're income property, whether they're rental property, different rules. This is only primary residence. They let you exclude a certain amount of gain. It used to also be that if you decided for a time period when you own that home, let's say you rented it out for a period of time. You rented it out, you moved, you came back, you lived in it again. The old rule was, as long as you lived in that home for any 2 of the 5 prior years before you sold it, you qualify for that exclusion I mentioned, $500,000 if you're married. That was the rule for quite a while. So people, what would they do? Maybe they'd move out of the house, they'd rent it for a while, but as long as they could prove that for 2 years of the previous 5 they lived in it, they got the full exclusion. Well, the IRS kind of caught hold of that. They saw there was a little loophole there. They're trying to raise revenues. They changed the rules now. So now it's not enough that you live in the house for only 2 of the 5 years. If you live in it for 2 of the 5 years, i.e. 40%, right? 2 of the 5, 40%, you're only going to be allowed to take 40% of that exclusion. So now they make you calculate, based on the number of days of those 5 years that you live in it, that's what you're allowed on the exclusion. So in this example, let's say you live in it 2 out of the 5 years, the normal exclusion would be $500,000 if there's that much of a gain. Now it's only 40% of that, which is, what, $200,000? So now the exclusion is $200,000, and you'd have to pay capital gains on the additional $300,000. So now they make you allocate and do a calculation based on how many days you lived there and how many days you didn't. It was a rental. So those rules have changed a little. The other item I wanted to talk about is this home buyer's credit that's pretty much phased out. It's pretty much gone now, where you had the maximum of $8,000 that you could get as a refund in your tax return for a new home. If you were a prior owner and you lived in the home a certain amount of time and then decided to buy another home, there was also a credit. I believe it was about $6,500 was the max, but there was still a credit available. That credit is pretty much gone, except if you are either a member of the military, so if you are or you know anyone who is a member of the military, or work for one of those government organizations, i.e., for example, the CIA, they have extended that until 2011. So those people still qualify for that tax credit.